Inflation's chaos to cause 79.95% S&P 500 decline and Third U.S. Great Depression, Part 2 of 2. The proprietary research findings in this presentation were produced by alphatac.com, whose slogan is Growing Assets Against the Wind. AlphaTac's Michael Markowski has made predictions using algorithms. With these algorithms, he has predicted all major crashes and corrections since 2007, including the crash that caused the 2008 Great Recession. This table depicts all of Michael Markowski's predicted crashes with declines ranging from 18.5% to 56.4%. He also predicted on March 20th, 2022, that the S&P 500 would decline by an additional minimum of 34.5%. Since then, the index has declined by as much as 18.5%. The recipe to cause a Great Depression is a recession coinciding with a significant stock market decline. This chart depicts the U.S.'s last 1929 to 1938 Great Depression. It began in August 1929, which was a month before the S&P 500 peaked in September of 1929. From its peak, the S&P 500 had declined 45% by December 1929 and did not reach its bottom, an 85% decline, until June of 1932. Part 1 of the presentation, research findings supporting 79.95% S&P 500 decline, is highly recommended and is available at alphatac.com.
Here's the Federal Reserve. Here's the next problem, okay? Here's the Federal Reserve discount rates in U.S. recessions, okay? So this is the, you can see that every single time the Fed has raised the discount rate since 1914, it has caused a recession. The probability is 100% that we're going to have a recession. Okay, there's only two, you see the two orange dots down there? Only 2 times that the Federal Reserve did not cause a recession. Okay, here it is from all the way to 2017. So it's baked in, it's coming. Okay, now here's the problem. See the bars on the left? This is inflation versus the Fed's discount rate. So what happened over there on the left where you see the circle, you can see the inflation's skyrocketing and the Fed's doing nothing. It's just the discount rate, they're not raising it. So what happens is so what happened next is they raise the discount rate. Finally, they raise it, okay, to stop inflation. And then what they do is they raise it during the recession, they raise it again, and they transform the economy from a recession to a depression. Okay, is what they did. Okay, so that was the first Great Depression, 1920 to 1921. GDP fell much further in that depression than the second Great Depression in 1929. We're talking a 33% decline in GDP. We're talking a 32% decline for the S&P 500. Okay, Fed's inflation rate changes. Okay, the inflation rate changes. So here is the Fed from 1925 to 1934. What I want you to notice is the bars below the axes, okay, are deflation. That was a deflationary period in the U.S. There was massive deflation back from 1800 all the way into this period. So what does the Fed? So you can see, what does the Fed do? The Fed raises the discount rate while we have serious deflation. So they basically, they cause serious damage to the economy, but more importantly, because deflation increases the value of financial assets and decreases the value of real estate and real assets, okay? So what they did is they drove the real yields on securities and bonds and stocks, they drove them to record highs. The S&P was yielding 25% back then on the real yield, because it works just the opposite as when you have inflation. So, so what happened? The U.S. home price index, this is the home price index from 1925 to 1929. It steadily declined. Why? Because real property declines in a deflationary environment. Okay? Now, what else did they did? They jacked the PE multiples to a record high, so they created a bubble high for the S&P 500. But this is the same chart here showing the S&P, and that's the S&P's bubble high in 1929. Okay, so here again, you can see here's all the deflation on the left, and all the discount rate hikes on the right. They're hiking all the way through a deflationary period. What that did is that protracted. We'll show you here. So here they are. Okay, you can see again deflation on the left and the yellow that you see. You can see here that they. Then you can see over here after the market crashed. Okay, then right over here you can see that right above that deflation, right below the S&P 1871 to 2020, that was a low for the S&P 500 for the entire history of the S&P. You can see the deflation, but they're hiking again. They didn't learn from that. They hiked again twice, and that extended the depression. Because why? No one wants to give anybody a mortgage when real estate's going down all the time. There was no mortgages available. They just choked off the entire real estate market. Okay. Now, what did this depression? What did this happen? All of their shenanigans. What it did is the depression. What happens in a depression is when deflation comes in, prices no longer go up, and everybody stops spending. So consumption and capital spending plummeted and did not get back to those levels until 1937. So it didn't get back to 1929 levels till 1937. GDP bottomed and did not get back, until 1937 because of that. And here's the U.S. home price index. It declined from 1920 to 1938 by 12.6%. Can you imagine? Okay. Now, the third U.S. Great Depression is inevitable. Why? Because the market and the economy have attributes that are similar to the prior U.S. Great Depressions. The primary causes of the two last Great Depressions, rampant inflation caused the first Great Depression because the Fed had to hike in a recession. Extremely overvalued S&P 500 caused the last Great Depression because they jacked it up so high with their hiking interest rates in a deflationary environment. So you can see here is the 2022. This is the inflation rate and the Federal Reserve's discount rate hikes, from 2000 to 2022. And you can see here, look at the inflation spike on the right. And look at where the discount rate is. It's eerily similar to 1919 and 2021. Eerily similar. Where's the PE multiples? Where's the PE multiples of 2020? That's the PE multiple. We by the way, this is the Alpha TAC PE multiple. We had to create our own proprietary PE multiple because none of the other ones adjust for inflation. Okay, so we have a proprietary PE multiple, and you can see here that our multiple, you can see here, all-time high in 2022. The Fed made a huge mistake when they did not raise the interest rates when inflation went to a record level middle of last year. What they did is instead of raising the rates to cool the S&P 500, they sent it to its best year, third best year since 1997. And it had more highs, new all-time highs last year, than the entire decades of the 1970s and the 2000s combined. More all-time highs for the S&P 500. They just sent the thing soaring, and we're going to pay the price. By the way, there's the multiple there on the left. The Alpha TAC PE is the only multiple that adjusts the PE for deflation. So yes, you can have a negative PE multiple, that happens to be the best. That was the best time you could have bought U.S. stocks in the entire last 200 years. Is right where you see that negative, that yellow circle down there, when PE was negative. And of course, so here's the other thing that we're up against. In 1929, the discount rate was 6%. Inflation was 0, and the dividend yield was positive 2.95. In 2000, discount rate was 5.3%, negative yield of 2.68. Now look, we got a discount rate of 0.25%. We got inflation at 7.48 and a negative yield of 4.86. So it's inevitable. It's cooked. Okay. So the only question remaining with which Great Depression will it mimic? Will it mimic 1920 to 1921, where 38 with a 32% S&P 500 decline, or it will mimic 1929 to 1938 at 85% S&P 500 decline? Okay, here is 1918 to 1924. What happened in 1918 is you can see the PE was 26.3 at 8/31/19, the ATPE. The index declined by 32%, and then we see it rallied back by October of 1922. It rallied back to, it made a strong rally back, and the PE at that point was only 6.2. So what happened is that then enabled it to recover, the economy to recover much faster, because the problem with a massive stock market decline is when it doesn't recover, people become fearful and stop spending. They retrench. Cap businesses and individuals will stop spending. So it's important that you get the market back up to within 10% or 15% of the highs as soon as possible. And of course, and they were able to do that, but why? Because the PE multiple was only at 6.2 in 1922. Now the problem with 1929 is the multiple was 6 points higher. It was 32.66, and you can see here, the market crashed by 45%. Everybody thought it was a great buy. When it rallied to the recovery high, the PE was back at 25.8, way too high. So what happened? Then what happens? It crashes again and goes down by 85%. Okay.
AlphaTac has two S&P 500 long, short, directional algorithms, the Bull and Bear Tracker and Alpha Centauri. $100 invested in Alpha Centauri's proprietary S&P 500 trading strategy in 1871 increased to $1,079,000 by June 2021. A buy and hold strategy of the S&P during the same time period grew $100 to only $96,000. $100 invested in the Bull and Bear Tracker in March 2018 had increased to $324 in May of 2022. For the same time period, that $100 in the S&P 500 grew to $151. $100 invested in the Bull and Bear Tracker in January 2022 had increased to $122 in May of 2022. For the same time period, that $100 in the S&P 500 declined to just $86. For information on how to get access to AlphaTac's algorithms, click below.